Imagine this. One small decision by your central bank, and suddenly, your monthly mortgage payment jumps by hundreds of dollars. Whether you live in the United States, Canada, the United Kingdom, or Australia, the next interest rate move could be the most important financial moment of your year. Will rates rise again, stay higher for longer, or finally start to fall? And more importantly, how will that decision hit your mortgage? Let's break it down region by region. Across these 4 countries, mortgage markets are tightly linked to central bank decisions. Over the past 2 years, rapid rate hikes have pushed borrowing costs to their highest levels in more than a decade. And right now, economists are divided. Some predict cuts, others warn of more hikes, and some say rates could stay elevated longer than expected. Either way, the next move will affect millions of mortgage holders. In the United States, the Federal Reserve has held rates between 5.25% and 5.5%, the highest in 23 years. Markets are expecting a potential cut in early 2026, but sticky inflation could delay that timeline. For millions of Americans with adjustable-rate mortgages, or those refinancing, a quarter-point move can mean $50 to $200 more per month on a typical $400,000 loan. And if you're buying, mortgage rates have hovered between 6.5% and 7%, making affordability a moving target that depends on the Fed's next decision. In Canada, the pressure is even greater. Canadians have one of the highest household debt-to-income ratios in the world, over 180%. The Bank of Canada began cutting earlier this year, but many borrowers are still struggling as 5-year fixed mortgages reset at much higher rates than when they were signed. For a $600,000 mortgage, a 1% change can add over $350 to monthly payments. If the bank pauses or reverses cuts, some households could be trapped between rising costs and shrinking budgets. The UK faces a wave of mortgage renewals. More than 1.5 million homeowners will renew their mortgages this year, many moving from ultra-low pandemic rates to deals 3 to 4% higher. The Bank of England has kept rates at 5.25%, closely watching inflation. A surprise hike would squeeze borrowers further. A cut might bring some relief, but slowly. Every 0.25% change means £40 to £80 extra per month on a typical mortgage. In Australia, most loans are variable, meaning households feel the impact almost immediately when rates change. The RBA has kept rates around 4.35%, but inflation remains stubborn, and analysts say one more hike isn't off the table. For a $750,000 mortgage, a 0.25% increase adds about $120 to $150 a month. With high living costs already pressuring families, the next move could be a real turning point. So, what will they do? Cut, hold, or hike? No one knows for sure. Each country faces a different mix of inflation, growth, and housing pressures. But one thing is certain, the decision is coming, and when it hits, it will ripple through every mortgage holder. The smartest strategy isn't to wait. It's to prepare. Step 1. Review your mortgage type, fixed, variable, or adjustable. Step 2. Calculate how a 0.25% to 1% change would affect your monthly payments. Step 3. Talk to your lender. Explore refinancing, locking in, or flexible terms. Step 4. Build a financial buffer. Even small cushions can make a big difference. No matter where you are, US, Canada, UK, or Australia, understanding your mortgage position is your best defense. If you found this video helpful, tap like, subscribe, and hit the bell icon to stay ahead of the next financial wave. Tell us in the comments where you're watching from and how rising rates are affecting you. We'll reply to as many as we can. The next rate move could be closer than you think.